Now, your S&P 500 target, do you have a new update for us?
So it's 3750, which sounds pretty bad. But to get to 3750 on the S&P 500, all you have to do is make a couple of assumptions. The first assumption that the forward P multiple drops to 16, and the second assumption that earnings estimates get cut by about 10% from current levels. I would say that neither of those two assumptions is really that draconian.
Our next guest has correctly called for the stock markets to go higher and the economy to continue growing without a hard landing. You can check out my previous interviews with him in the links down below. But now he's changing his stance. Peter Berezin joins us today. He is the chief global strategist at BCA Research, and he's going to explain to us why he's now bearish, expecting an up to 30% decline in the S&P 500 as a recession eventually rolls in. Peter, welcome back to the show.
Good to be back on.
Peter, like I said in the introduction, you've correctly called for the stock markets to go higher, but you've changed from being moderately constructive to neutral to now bearish. Walk us through the logic of changing your outlook.
In wrestling parlance, I've gone from being a face to a heel. I'm bearish on stocks. The analogy that I've been using is that of a glass of water. So imagine taking a warm glass of water and putting it into the freezer. And if you're kind of periodically opening the freezer every few minutes, it'll still look like it'll still look like water for a while, but eventually it'll freeze over and turn to ice. It'll undergo this phase transition. So suppose that I'm not talking about the temperature of the freezer anymore. We're talking about the stance of monetary policy. Monetary policy has been tight now for a couple of years, but the economy was so hot 2 years ago that it's taken a while for it to cool down to the point that it could freeze over. 2 years ago, we had all those excess pandemic savings. We had the huge numbers of job openings. People would lose a job, no problem, walk across the street and find new work. We had the fact that people renegotiated their mortgage during the pandemic at very favorable rates. Unfortunately, all of that insulation has sort of worn thin at this point. The excess savings are gone. The job openings are down to more normal levels. And increasingly, a larger share of people are faced with these higher rate mortgages, not just households, by the way, but businesses also that renewed their loans at very low rates and now are seeing their rates go up. So unfortunately, that glass of water is very close to freezing over. When it freezes over, we'll have a recession.
Let's talk about this recession in just a minute, but going back to the stock markets may not be always reflective of the real economy, right? Just because perhaps the economy is slowing down in growth doesn't necessarily mean this euphoria or bullish sentiment would dissipate. Is that true?
Within moderation. So, if you look at the equal weight index, if you look at small caps, they're performing much more in line with what you would expect from a slowing economy. The S&P 500, which of course is now heavily dominated by a handful of tech stocks, is outperforming the other indices. But that bullish sentiment will fall to the wayside if the economy enters a recession. It always does. People are not going to remain euphoric on stocks if unemployment is surging. So I don't think that the AI names are going to bail out the S&P. Far from it. They could actually underperform the S&P if we enter a recession.
Well, you've been moderately constructive, or I guess cautiously optimistic for quite some time, Peter, but has there been a recent event or catalyst that made you change your mind and switch to a more bearish stance, or was it just a sequence of events that built up over the last 6 months?
I think the most important consideration is the consumer. So that is, consumption 70%. The economy, get the consumer right, you're going to get the economy right. And right now, I think there's actually real reason to worry that consumer spending is going to slow sharply. And I say that for the following reason. There are three ways that people can spend. They can draw on past income, they can spend out of current income, or they can borrow against future income. As I mentioned earlier, those pandemic savings are gone. So the ability to use past incomes is no longer there for many households. The savings rate is still very, very low. It's under 4%. Right now, it was over 6% in 2019. So the ability of households to increase spending out of current income isn't there either. And then finally, borrowing against future income. Delinquency rates on credit cards now are as high as they were in 2010. 2010, the unemployment rate was 9%. It's 4% now. We have the same delinquency rate. So banks are responding by tightening lending standards. They've already increased interest rates on credit cards, the highest in history. And consumers now, even if they want to, won't be able to keep on increasing their credit card balances, which means that they're going to have to spend less. And so if consumption turns down, I have to say it's going to be very hard for the US economy to avoid a recession.
This came in from Bloomberg 2 months ago in April. It says small businesses, U.S. small businesses, rent delinquencies rise to a 3-year high. The small business report, rent report from Alignable, which provides an online networking platform for owners, found that 43% of small businesses were unable to pay their rent in full due to economic headwinds. That's the highest rent delinquency rate since March 2021. That broadly supports what you just said. What's going on with small businesses, Peter?
Well, what's going on with small businesses is that revenue growth is slowing and cost pressures are still there. So if you look at the NFIB small business survey, it's improved a bit, but it's still looking pretty weak. And unfortunately, it's going to get worse because more businesses are going to see their loans mature over the next couple of years. And even if the Fed cuts rates, they're still going to be having to pay higher rates than they did 3 years ago. That's something that people forget. What matters for the economy is not the Fed funds rate. What matters for the economy is what is the rate that you're paying on your mortgage? What is the rate that a business is paying on its bank loan? As those loans reset, the effective mortgage rate is going to go up, even if the Fed funds rate goes down.
What's going to happen to the labor market, Peter? What do you anticipate to happen to the unemployment rate? Last we checked, is 4%.
Well, it's starting to move higher, which is quite dangerous. The unemployment rate on a 3-month average has already moved up 0.4 percentage points. Well, the old Psalm rule says that if it moves up half a percentage point, so we're almost there, then a recession becomes inevitable. That might not work this time, but the point is that labor demand is slowing. And yeah, we got a good JOLTS number today, somewhat stronger job openings, but JOLTS are a very noisy series. They're very lagging. If you look at the number of job openings as calculated by Indeed, which is a big online job site, or Uplink, or Link Up rather. That's an analytics firm that scours all the HR websites amongst the top employers in the U.S., tabulates the job openings. Those numbers still look like they're weakening, and so again, the water in that glass has gotten pretty cold. And if monetary policy remains tight, as it will, because the Fed is not going to cut rates aggressively outside of recession, the glass will eventually freeze over into ice.
Well, the U.S. labor market has been tight since 2023. Relatively few vacancies and relatively fewer jobs still, or available workers to fill those vacancies. Do you see that changing anytime soon?
Well, it is changing. I mean, if you look at the ratio of job openings to unemployed workers, it was at record highs in 2022. We're now back to 2019 levels. The difference between now and 2019 is that in 2019, that ratio was kind of stable. Now it's going down. The momentum is to the downside. And again, unless the Fed starts to cut rates very, very aggressively, which they will not do, Jay Powell has said that he's not going to do massive, aggressive, proactive easing because the risks of a second wave of inflation are too high. The economy is heading for a recession.
What's keeping Fed Chair Powell at bay here in terms of cutting rates? His peers, the ECB, the Bank of Canada, have all cut rates despite inflation in Canada, for example, remaining higher than the Bank of Canada's 2% inflation target. Why is the Fed still keeping rates higher for longer?
Because they talked about how inflation wouldn't go up and then it went up. And so they were so burnt by that whole transitory narrative that they don't want to repeat it again. So I know everyone wants those rate cuts, and we'll probably get a couple of rate cuts later this year. But as I mentioned, what matters is not the Fed funds rate. What matters is the effective rate that people are paying. That's going up, not down. So monetary policy is not going to loosen fast enough. Fiscal policy is not going to loosen either. The budget deficit is 7% of GDP. Think it's going to go up? It's not going to go up. And so we're not going to get that fiscal support in the form of increased budget deficits next year. If anything, there might be pressure on the next administration, whether that's a Trump administration or Democrat administration, to bring down that deficit. In the case of Democrats, through higher taxes. In the case of Republicans, through lower government spending.
Suppose the Fed were to cut at the next meeting in July, just hypothetically, would that be enough to avert this recession that we're talking about?
Well, if they start cutting in July, which I don't think they will, but if they do it and they keep on cutting, and so if the Fed funds rate is down like, I don't know, 150 basis points by the end of this year, then yeah, maybe that's enough to prevent a recession. But at this point, you have to kind of say, well, if they cut so much, so outside of recession, don't they then run the other risk of loosening financial conditions so much that you get a resurgence of inflation? So it's a bit like that Milton Friedman fool in the shower metaphor, where you're kind of in the shower and you're trying to turn the knob to get the right temperature, but there's a long delay between when you turn the knob and what happens to the temperature. So you're either scalding hot or freezing cold. The Fed could turn that knob just right. It's possible. There's no there's no fundamental law of the universe that prevents them from doing it, but it's just unlikely.
Well, let's just evaluate this risk of inflation returning, suppose the Fed cuts rates. So let's take Canada, for example. The Bank of Canada cut a couple weeks ago, last month. The inflation rate was 2.7% in April. It's now unexpectedly higher at 2.9%. I don't know if this is a result of the Fed cut, or not the Fed cut, the Bank of Canada cut. Surely not, because there's a lag. But the risk there remains, right? That's an example. Could that happen to the U.S.?
It's a risk. It's a risk. So, one of the things that kind of was working in the Fed's favor going into the pandemic was that inflation had been below 2% for close to a decade, because you had mass unemployment following the global financial crisis. And so PC inflation was typically around 1.5% rather than 2%. And so the Fed had this kind of get out of jail card that it could use, all that credibility that it accumulated because inflation was continually undershooting its target. But at this point, that get out of jail card has been used. Inflation was way above what it should have been for a couple of years. So that the price level now is actually slightly higher than where it should have been had it just grown at 2% since 2008. So I think the Fed has to be extra worried about providing too much stimulus. So again, it's that fool in the shower. Can you turn the knob just right, knowing that there's a long lag between when you turn it and what the temperature of the water will be? You could get lucky. It's possible. But if you're an investor, do you want to bet on that sort of luck? I wouldn't.
Now, your S&P 500 target, do you have a new update for us?
So it's 3750, which sounds pretty bad, and it is relative to where the S&P is now. But to get to 3750 on the S&P 500, all you have to do is make a couple of assumptions. The first assumption, that the forward P multiple drops to 16, and the second assumption, that earnings estimates get cut by about 10% from current levels. I would say that neither of those two assumptions is really that draconian. So a 16p multiple, between 2012 and 2019, the S&P averaged a P multiple of 15.8. So going down to 16 would still leave it slightly above where it was between 2012 and 2019, a period that didn't even include a recession. So it's not really that aggressive. Likewise, a decline in earnings estimates of 10%. You look at the last three recessions, earnings estimates were cut by a lot more than 10%. And this time around, they could be cut even more because profit margins are so high. They're like a good percentage point higher than they were in 2019. So if you believe in mean reversion and margins, then those estimates could go down way more than 10%. And again, all it takes is a 10% cut in earnings estimates and a 16 PE to get you to 37.50 on the S&P 500.
And this earnings cut will be mainly driven by a slowdown in consumer spending, Peter?
Uh, they're feedback loops. So consumers spend less, firms hire fewer workers, which means that there's less income. Less income means less consumption, which means even less hiring. And away you go. And of course, capex. Economists describe capex as derived demand. Firms are not going to invest in new capacity unless they think there's going to be enough sales to justify that investment. If consumers are spending less, then capex is going to go down, and these things will just sort of snowball. And yes, eventually, the Fed will cut rates by enough, the economy will recover. But in the meantime, unemployment will go from 4% to 6% or 7%.
I think Nvidia alone accounted for a big chunk of the PE growth of the S&P 500. So when you're calling for 37.50, are you assuming that the tech stocks, Nvidia, for example, and the Magnificent Seven will lead this decline back downward? Do you anticipate them to stay more or less where they are, and the other, I guess, non-magnificent 497, 493, if you want to call them that, that sector, that part of the stock market will lead the charge downward? What's going to come first?
I think the tech stocks will probably underperform the rest of the index because they're so expensive. People sell their winners when times get tough. Right now, investors are putting a lot of weight on the assumption that AI is going to boost productivity growth, and B, the firms will actually be able to monetize that additional productivity growth. Neither assumption is really that clear cuts. So it's certainly possible that AI will boost productivity growth, just in the same way that the computer age boosted productivity growth. US productivity growth went up by a percentage point between 1995 and 2005. But if you recall back then, it really wasn't until 2005 the firms finally figured out how to monetize the internet. So even if AI boosts productivity, it may take a while for firms to actually make any money off it. Right now, what we're seeing with these large language models is sort of a convergence in terms of performance. So whether you use ChatGPT, Gemini, Claude, any of these kind of offerings, they're all kind of the same. You ask the same question and you get kind of the same response. So where's the competitive edge? It could turn out to be that these AI models end up functioning a bit like airlines, right? When the airline was introduced, it really boosted global productivity growth. People could fly all over the world very quickly and safely. But did airlines actually make any money off it? No, because it was such a competitive industry. So the point is not that AI is going to be a complete bust. Maybe AI boosts productivity growth, but we don't even know whether that will happen. And even if it does happen, it might take many, many years for companies to actually figure out how to make money off it. Right now, NVIDIA is making money off AI. NVIDIA is really the only company that's making money off AI, just like Cisco was making a lot of money off the internet in 2000. But Cisco also, in fact, Cisco today is 45% below its share price than it was in 2000, even though earnings and sales have grown a lot since then. So NVIDIA may just fail to live up to expectations.
Speaking of earnings on AI, Sam Altman, CEO of OpenAI, was asked at a conference how he plans to generate revenue. And he says,
"We have no current plans to make revenue. We have no idea how we may one day generate revenue. We have made a soft promise to investors that once we've built this sort of generally intelligent system, basically, we will ask it to figure out a way to generate an investment return for you."
It sounds like a sitcom, but that's what they're doing. They're just delaying the business plan aspect and making the product right now. To your point, I wonder what this means for the legacy big tech companies, though. Do you see a future in the Googles and the Amazons and the now Alphabet, Metas? All of them are developing AI. We're embracing it in some sense.
It's kind of funny. Like Google is so profitable because its search engine is good, but it's not great in the sense that if, for example, suppose you want to fly from Vancouver to San Francisco. Okay, you can go to Google and you can sort of type in a bunch of things and it'll give you a bunch of links to click. And if you click those links, Google makes some money. Now, suppose you replace kind of the Google search engine now with what Google is trying to do, replace it with AI. And that AI is going to tell you, okay, David, here's the flight that you want to take on this day at this time. Here's going to be the cheapest fare for that particular route. And this is all great. This is useful information. Google is going to tell me all of that. But how does Google actually make money? Like if Google gives you the right response, take this airline at this time, great. But Google, if it's honest, if the search engine is honest, if the AI is doing its job, it's just going to give you the information. There's no link to click. There's no money for Google to make. Now, maybe Google figures it out, or maybe they don't, or maybe they do, but it takes like 5 years or 10 years. I think that's the risk for investors.
During this recession, do you see sectors that will outperform? Are we sticking to the defensives, utilities? Telecoms got wrecked this year. Perhaps they'll see a rebound. What's your take?
I think you want to stick with the defensive sectors. I think you want to stick with utilities, consumer staples, healthcare. Healthcare is my favorite sector because it's relatively cheap. It's going to have some pricing power, unlike most other sectors over the next couple of years, because in healthcare, prices are negotiated. And what happened for the last couple of years is that prices elsewhere in the economy went up, but healthcare prices, because they're tied to contracts, didn't rise as much. So healthcare profit margins really contracted. We're starting to see that change. In fact, healthcare is one of the parts of the CPI where prices are still increasing at a meaningful rate. And then you got the structural tailwinds from aging populations and also from AI. Drug discovery is going to become a lot easier with AI, and that's going to benefit healthcare names. So stick with those defensive sectors going into the latter half of this year.
Final question on the U.S. economy, then I'll move on to China. Do you anticipate changes to your forecasts if either Trump or Biden wins? In other words, will the outcome of the election change the way you position yourself?
And potentially, we'll just have to see whether Trump, if he wins, is able to get a Republican Congress, which he might be able to do, and presumably will be able to do. Now, I have to say, it's not at all obvious to me that the consensus narrative, the bond yields are going to go up a lot if Trump wins, actually turns out to be true. Because the prevailing wisdom is that if Trump wins, we're going to get another big unfunded tax cut, and that's going to send yields higher. But I think there's two problems with that. One, it's not clear that Trump will be able to get a tax cut through Congress. Interest rates are a lot higher now. The deficit is 7% of GDP, not 2% like it was in 2016. So there could be more opposition from moderate Republicans. And even if he does get a tax cut through Congress, think about what happened to the first tax cut. Bond yields going into the 2016 election were at 1.6% on the 10-year. They went up to 3% because everyone thought that these tax cuts that Trump had been campaigning on would significantly boost growth. They didn't boost growth. There was really no increase in non-residential capital spending following those tax cuts. And so by 2019, the 10-year yield was back down to 1.6%. So even if Trump does get another tax cut through, the growth benefits might be rather disappointing. And it's actually quite possible that in negotiating this tax cut, Republicans demand some spending cuts. Now, here's the thing. The multiplier on spending is a lot higher than the multiplier on tax cuts. So if we have a tax cut that's coupled with spending restraint, the overall net effect on aggregate demand could be negative, and that means lower bond yields, not higher bond yields.
I think Trump has expressed interest in raising tariffs to supplement some of these tax cuts. What's your view on raising tariffs? Would that be good or bad for corporate margins?
It'll be bad for corporate margins because it's a tax that companies will pay. I mean, the way Trump kind of talks about it, you would think that it's just a bunch of Chinese companies that are selling stuff to the US. That's not what's happening. These are US companies with production facilities in China, manufacturing stuff in China, and then bringing it over to the US. If tariffs go up, that's like a sales tax. They're going to pass on that cost to consumers. It has a negative effect on inflation in the sense that it boosts inflation in the short term. But down the road, it has a growth reducing effect, just like any tax cut does.
Good segue to talk about China now. This is a article from Times Magazine. I'm just going to read the first paragraph. China is in the midst of a profound economic crisis. Growth rates are flagging as an unsustainable mountain of debt piles up. China's debt to GDP ratio reached a record 288% in 2023, but even that eye-popping figure does not capture the uncomfortable fact that much of it was borrowed to buy assets that no longer yield enough income to pay the debt. This is especially true in the housing sector, where sales have fallen by a third since the pre-pandemic peak, and new construction is down 60%. This is one of the worst housing crashes in the world over the last 3 decades. Is this more in line with your research, Peter?
Yeah, so China is starting to look like a lot like Japan in the early 1990s. If you recall what happened back then, when the Japanese stock market burst, the housing bubble burst, you had this big increase in private sector savings because companies didn't want to invest in new capacity, households wanted to save more. And so what did the government do? Well, the government was forced ultimately to absorb those private sector savings with its own savings by running large fiscal deficits. And those fiscal deficits arguably were actually too small. The economy probably would have benefited from more fiscal stimulus, but at least the large fiscal deficits that Japan ran kept the economy out of a depression. So China faces the same issue. The private sector in China saves a lot. They don't spend much of what they earn. And so you have these excess savings that up until a couple of years ago kind of flowed into the housing market and allowed the construction of all these new apartment buildings. That's ended now, but the savings are still there. So unless the government is willing to run large budget deficits, and certainly politically, it doesn't seem like they want to, they're going to have a deflationary problem, not an inflationary problem.
The Chinese consumer, are they how are they going to, I guess, I don't know if I want to use the word survive, but how are they going to fare during this crisis? Are we going to see a big slowdown in consumer spending, or is this ultimately just going to affect the government more than the consumer?
Well, consumption is already fairly weak in China. Historically, it has been weak. If you look at the household savings rate, it's much higher in China than it is in most other economies. And of course, for Chinese households, the principal asset is the home. The home that they bought, or if they bought several homes, the property that they own, the value of that asset is going down now and going down pretty quickly. And so if you're having this negative wealth effect, if you're feeling less wealthy, then chances are you're going to spend less. So yeah, consumption already is weak and could get weaker.
I wonder how this affects other assets. So according to the World Gold Council, which I looked at earlier this year, Chinese demand for gold has increased by 68% year over year. Partly, I guess, in line with what's going on with the housing sector. They're buying other assets to protect their wealth. Do you think that this trend is going to continue, Peter?
So gold has been really interesting in the sense that gold prices have been pretty strong for the last couple of years, despite the fact that real bond yields have gone up, despite the fact that flows into the GLD and other US-based ETFs have been trending lower. China and other EMs have really picked up the slack. But here's the problem. Historically, the PBOC, the China's central bank, has been quite price sensitive in its purchases of gold. And we've already seen the PBOC cut back on its gold buying in response to higher prices. And then on the retail side, I think I'm certainly getting the feeling that the authorities are looking at gold purchases by ordinary Chinese households as a form of disguised capital flight. And they don't want capital flight. And so they might tighten the screws around retail gold purchases. And if that happens, then gold prices probably are not going to go up. Now, they might not go down, because I think gold is a defensive asset that you want to own if times get tough. But I think the upside for gold is also quite limited at this point.
Fair enough. What are the broader geopolitical ramifications of a slowing down or collapsing Chinese economy, you think?
Well, it's not good, right? Usually when times get tough, you look for an external enemy to blame. And if China has trouble, it'll kind of potentially start blaming the rest of the world for its ordeal. And certainly, if Trump wins and raises tariffs on China, it's going to create a plausible case for making that sort of claim. So the geopolitics are not helpful right now. I mean, I don't want to be too dire. There is a window by which things could improve, but there's certainly a larger window in which things deteriorate on the geopolitical side, both in Asia and in the Middle East.
To what extent will China's slowdown affect base metals? The multi-decade growth story for China has been partly responsible for increasing copper prices, steel, aluminum, so on and so forth. What's next?
Yeah, so it's important to remember that certain metals like copper are typically used at the end of the construction cycle. In China, we've seen a huge decline in housing starts. They're down 60% from their peak, but completions are only down 5% because there were all these projects the developers didn't have the money to finish. The government gave them the financing and they're finishing those projects. And in those end stages of completion, you do need a lot of copper for the pipes, for the wiring, for the air conditioning units, and things like that. My worry for base metals is what happens when the completions are complete. You don't have a new pipeline of projects starting up. And so we're going to see a pretty significant decline in base metal demand. And that could happen at the same time that China's EV industry, which is already overextended, already is facing capacity issues. They're just producing more than there's demand. We're going to see a slowdown in EV production that will also reduce demand for base metals. So in the near term, I'm not sanguine about copper or other metals. Longer term, that's going to be potentially a different story because supply is quite constrained for metals. And if the whole green transition, despite all the bumps and hiccups and speed bumps with EVs today, if that kind of gathers steam, that's going to be good for metals. But in the near term, I think both oil and metals are in trouble.
Well, the China A-shares index has been holding up relatively well despite this economic slowdown, Peter. What do you think is propping up the Chinese real stock market?
Well, I mean, propping up at very cheap levels, right?
Yeah.
Chinese stocks are incredibly cheap by standard valuation measures such as price to earnings, price to book. And so there are some value hunters out there. I don't expect Chinese stocks to crash. This isn't Japan in that sense. Japanese stocks are trading at 100 times PE. Chinese stocks are trading at like 8 times PE. So I don't think China's going to have a big stock market crash. Stocks will probably be flat, maybe even move down a bit as global equities in general trend lower. But that's not a big chunk of the economy. The stock market in China is a very, very small share of GDP compared to the U.S.
Okay, ultimately then, Peter, China's slowdown, how will that affect the U.S. and other Western countries, if at all?
Well, I think probably the most important effect will be in a deflationary direction, because if China fails to reaccelerate and metal prices go down, input prices go down, import prices before the tariffs are paid go down, that helps to restrain U.S. inflation. And so what I've been telling clients is now this is the good time to lighten up on stocks and increase your exposure to long-term bonds. Bought some TLT for my portfolio yesterday. I like that purchase. I want to be going into long-duration bonds now, away from stocks.
Oh, just one question about that. The 10-year has been rising, especially after the debate with Biden and Trump. It just spiked the day after. I don't know if you saw that. So it's. Do you think it'll go back up to 5%, or is this the peak?
I think this is the peak. And like I said before, I think the reason the 10-year has risen is because people are thinking, I remember in 2016, the 10-year went from 1.6 to 3% as everyone got enthusiastic about those tax cuts. Tax cuts eventually occurred, and then the 10-year went down to 1.6 in 2019. So let's think not 18 months, let's think like 3 years. It's not at all obvious that the US will be able to maintain this large budget deficit. If they have to bring it down, that's deflationary, not inflationary.
Thank you very much for your thoughts, Peter. We'll talk next time. Plenty more to discuss. Where can we follow your work in the meantime?
So you can go to Twitter. I still call it Twitter, not X. Go to Twitter. I've got an account there, and I also occasionally post on LinkedIn. But most importantly, please go to bcaresearch.com. If you're not a client, find out how to get a trial.
Okay. We'll put the links in the description down below, so make sure to follow BCA and Peter there. Thank you very much for your time. We'll speak next time.
Thank you.
Thank you for watching. Don't forget to like and subscribe.